Picture this, you've been saving diligently, and now you're ready to put your money to work. But where do you start? Welcome to the world of investing. When we talk about investing, we're referring to the act of committing your money with the intention of making a profit. It's like planting a seed and nurturing it to grow into a thriving tree, except the tree is your wealth, and the nurturing is your strategic planning. Investing isn't a get-rich-quick scheme. It's a process that takes time, patience, and a good understanding of the basics. Why is this important? Because knowing the fundamentals gives you the confidence to make informed decisions. It helps you navigate market ups and downs, and ultimately, it's the key to making your money work harder for you. Remember, it's not just about making money, but also about understanding how to make your money work for you. You've probably heard the term stock thrown around, but what exactly does it mean? Well, in a nutshell, a stock represents a piece of ownership in a company. When you buy a stock, you're buying a small slice of that company, becoming a part owner or shareholder. Now, owning a stock can be quite beneficial. It allows you to share in the company's profitability. If the company does well, the value of your stock may increase. You might even receive a portion of the company's profits in the form of dividends. However, with great potential comes great risk. If the company doesn't perform well, the value of your stock could decrease. Plus, stock prices are influenced by a myriad of factors, from company performance and economic conditions to market sentiment and global events. In other words, the stock market is a bit like a roller coaster ride. There are highs and lows, but over the long run, it can be a thrilling journey towards wealth accumulation. So stocks can be a powerful tool for wealth creation, but they also come with their share of risks. Now let's switch gears and talk about bonds, the so-called safe bet of the investing world. Imagine lending money to a friend with the promise that they'll pay you back with a bit of interest. That's essentially what a bond is, an IOU from a company or government to you, the investor. With bonds, the risk is generally lower than with stocks. Why? Because your friend is legally obligated to pay you back, just as companies and governments are obligated to return your investment with a bit of interest. But what about potential returns? Well, stocks can offer higher returns, but with greater risk. Bonds, on the other hand, provide more modest but steady returns. It's like choosing between a wild roller coaster ride and a gentle merry-go-round. So, if you're looking for predictability and a sense of security in your investments, bonds can offer that peace of mind. While bonds might not make you a millionaire overnight, they offer a level of stability that can be a valuable part of any investment strategy. Now that we've laid the groundwork, let's talk about the most exciting part: building wealth. Let's start with a magic phrase: compound interest. Simply put, compound interest is the interest on your interest. It's your money making money, and the longer it works, the more money it makes. This is why starting early is so crucial. The power of compound interest can turn small, consistent investments into substantial wealth over time. It's not about striking it rich overnight, but about steadily growing your wealth. The other key aspect to building wealth is balancing your portfolio. It's a bit like cooking a good meal. You need the right mix of ingredients, in this case, stocks and bonds. By maintaining a balanced portfolio, you can weather market fluctuations and keep your wealth growing. Remember, wealth isn't built in a day. It's a journey that requires patience, consistency, and a bit of savvy. So there you have it, a crash course on investing basics. We've journeyed through the world of stocks, understanding them as shares in a company that come with their own set of benefits and risks. We've learned that factors like company performance and market conditions can influence stock prices. We've also delved into bonds, acknowledging them as IOUs that provide a safer, more predictable return on investment. We compared these returns with those of stocks, highlighting the contrasting risk profiles. We then explored the potent principle of compound interest, underscoring the magic of starting early and staying consistent. We talked about the significance of balancing a portfolio for long-term growth, a strategy that can help mitigate risks and maximize returns. Now, you're equipped with the basics to start your investment journey. Don't forget to like, subscribe, and leave your comments below. Happy investing!